listen-only mode.
Hello everyone, welcome to Bursa Young Investor Club webinar. Thank you so much for coming. And my name is Shane. I am the moderator for this webinar. Now to ensure that you can hear us, I want to do an audio check now. So on your screen, there should be a webinar control panel. Do you manage to find it? So if you can find it, there's a button to indicate that you can raise hand. So if you can hear me clearly, could you please click the button, raise hand button? All right, I'm seeing some hands now. If you can hear me clearly, could you please click raise the hand button? All right, impressive. All right, you may put down your hands now. Okay, thank you very much. Now we are doing this program live, so let me turn on my webcam in case for you to see me. PC, would like to turn on your webcam? Hi, you can see me or not? All right, this is Shane. And
Yep, and I'm PC.
All right, awesome. So, but to save the bandwidth for this webinar, so we would like to remain webcam off for the entire session so that we can have a smoother internet connectivity. Right, so let me turn off my webcam now. Yeah, PC, you also can turn off your webcam. So today we have an amazing turnout of our webinar attendees. We feel very encouraged. Right now, we are already full house. All right, we are oversubscribed by 400 over people. So we received about 500 registration for this webinar. Today, we already have 100 people in the room. So, the first step to success is by showing up. As you know, our maximum capacity for this webinar is about 100 packs. So for those of you who are watching it right now, you are one of the first 100 people who attended. And I want to congratulate and thank each one of you for showing up to learn about investing. Now, for those who can't make it to catch our webinar online, no worries, because you will be sent a recording shortly. So next time, make sure you log in early to secure our precious seat. Now, our topic today is about mastering financial statements. Now, our speaker today has spent incredible amount of time to learn about financial statements, and today you will learn about how you can dissect financial statements to the bone. Now, the webinar is approximately 90 minutes long, and it consists of two segments. The first segment is 60-minute content by our speaker, and it followed by a 30-minute Q&A. But the timing is tentative because sometimes we have a lot of overwhelming questions, so our speaker may spend more time to answer those questions. Now, disclaimer. Now, this program is organized for educational purpose only. So in no way that we recommend any buy or sell for any particular stock. So you just use our information as a reference and as education. Now, we also have a series of webinar lined up for the year. Now, last week we did a real estate investment trust for our audience, and I think a lot of them walk away with a fruitful experience learning how to invest in REITs. Now, we also recommended a few REITs that we feel we used a few REITs as a case study, and of course, I think that a lot of you will benefit from our REITs topic last week. Now, today we are doing master financial statement, and in the following, we also have installed 8 more webinar sessions for you. Next month, we have mastering financial ratio. We'll go into financial ratio. Then we talk about introduction to candlestick, how to invest in growth stock, how to invest in cyclical stock, how to invest in value stock, how to invest in turnaround stock, and how to identify a sunset stock. And ultimately, we'll talk about this, uncover the myth of oil and gas industry. So these are 10 webinars that we have planned for the year, and along the way, if we see the response is good, then we can increase more sessions subsequently. Now, this series of webinar is brought to you by Bursa Malaysia and is managed by LifeChamp. Now, without further ado, let me introduce our speaker today. Now, our speaker graduated from NUS in 1989, and he has more than 26 years of working experience with several publicly listed companies and multinational companies. He's also author of 2 stock investment books, including Invest in REITs. Now, he is now a full-time investor, author, and trainer, and have been investing in the Bursa market and national market since 1995. So without further ado, PC, I'm passing it to you. Okay, let me change you as the presenter. Just give me a minute. Yeah, there are just too many of you. All right, PC, this is now your session. You can turn on your screen.
Okay, done. Okay, so today we are talking about mastering financial statements. Some of the topics which we will discuss would include learn the language of business and the basic 3 financial statements, learn to dissect income statement and its key items, and learn to dissect balance sheet and its key items, followed lastly by dissecting the cash flow and its key items. So before we even start, I want to give this as a reminder. Now, a lot of people, when they invest, they follow what analysts say in the newspaper, or they would hear it from someone else who hear it from someone else, and forever it will be they say and never you say. Okay, so that's why you can make it your say when you look at the most single important information to track a company's performance, and that is the quarterly report. Now, in it lies the financial statements that dictate the financial health of a company. And if you master it, you will be able to make wise decisions in investment. So always look at the quarterly report, okay? Because there's a lot of hints and there's a lot of management plan and management vision that is put into that report, okay? Now, what moves a share price? A share price growth is reflected of the following: a growth in revenue and net profit, which is a measure of the assets utilization, how the company utilize its assets, okay, to generate growth in revenue and profit, and future or potential growth in a company, okay, and this has a lot to do with the management vision and action. And you have the growth in the company's equity, okay, which is the utilization and management of financial resources by the management, okay. Now, if let's say a company does not utilize its assets wisely, then you will most probably see a slowing growth in revenue or even a net loss instead of a net profit. Okay, management must have vision so that they know where they want to be in the future, okay, and also growing the shareholders' value. And the other thing is knowing how to manage a company's financial resources, because if a company does not know how to manage its own financial resources, then you have a lot of wastages, okay, and besides, there will be a lot of transactions that will become questionable. Now, to gauge the potential of a company, you need to keep track of a company's performance by analyzing its quarterly report. So let's look at the quarterly report, and we will begin our language of business. Now, common items in the quarterly report, this is based on what I normally do, okay, would be to look at its revenue, net profit, earnings per share, which are found in the income statement, okay, current and non-current assets, current and non-current liabilities, okay, and equity, which is found in the balance sheet. And then cash flow from operating activities and net change in cash, which is from the cash flow statement, dividend and management action plans, which are found in the dividend and review of performance report. Now, when you look at certain items, okay, in all these statements, always look for the big ticket items, because there's no point if you focus on something that has just increased by, a few thousand ringgit, but then it in terms of percentage of an increase over the previous year, let's say it's 50% or even 100%. And if a company's transaction is in the multi-millions, that few thousand is actually negligible, even though it may show as a 50% or 100% increase, because it wouldn't impact the profit so much as those big ticket items. Yeah. So in the income statement, revenue is what the company receives when it sells its products or services to another party. The other is the net profit, which is what the company earns after deducting all related costs, including the product and service costs, operating costs, and administrative and financing costs, and tax. Okay. Earnings per share is derived from the net profit after dividing it with the number of shares in circulation. So these are pretty basic, but most importantly, okay, the above three items in the current year are normally measured against the prior years, okay, or through a quarter-on-quarter basis or a year-on-year basis to provide investors with a clue of the company's growth trajectory. Now, when you look at the income statement, you must know whether it is on a growth trajectory or not by comparing it to the previous years, okay? And sometimes people would ask me, how do you normally compare? Well, normally I just compare with the previous year. I hardly compare over, the last 2, 3, 5 years and so on, because right now the global economy is very fast changing, okay? And if a company performed 5 years very well, okay, but the company is performing in the last 2 years badly, it doesn't mean that the company can go back to its previous 5 years growth, because certain economic conditions could have changed, certain input of technology could have changed, and there could be a change in management. So that's why I often look at on a year-on-year basis, okay, to be more in tune with what is the company's growth trajectory rather than relying back on past histories, because in this digital age, things move very fast, and a company management must be highly dynamic to the changes, react dynamically to the changes, not as thinking back of yesteryears, because a lot of companies that do very well, okay, previously, they are no longer in existence as well. So that's why you need to know what is the more current situation. Yeah. And it is also worthwhile to compare various costs quarter on quarter or year on year to gauge the management competence in managing costs, as these have a direct impact on the company's net profit. But as I mentioned, look for the big ticket items. Okay.
PC.
So next one. Yeah.
Could you, I think some of us here may not know what is quarter on quarter or year on year. Would you explain a little bit?
Okay. So normally, quarter on quarter means how if a company reports its first quarter 2017, okay, quarter on quarter means you compare to a similar quarter of first quarter 2016. So between first quarter 2017 to first quarter 2016, you will be able to know that is year on year. Sorry, when you compare it to the previous year, it's year on year. For example, if a company reports Q2 2017 and then Q1 2017, when you compare Q2 with Q1 2017, that is called quarter on quarter. Yeah. And year on year means you compare the same quarter but with the previous year. For example, Q1 2017 versus Q1 2016. That will be year on year. Okay. Is that clear?
Yeah, they can't answer you, but I think your explanation is very clear. Yeah, but basically year on year will get rid of all the seasonality of the effect, because some quarter they, like for example, quarter 4 in a year, usually the retail sales will do well because of the holiday season and so on. So but you can't compare Q3 and Q4 sales. So basically year on year will remove all the seasonality. Yeah,
that's quite true. So normally I would pay more attention on the year on year than quarter on quarter, okay, because like Shane says, okay, Q3 and Q4 may have some deep variances, okay, but year on year would, like, everything is all averaged out, okay. So year on year would give you a more precise read of the current company's position. So balance sheet, things that I look out for is current assets, okay, which are actually cash and other assets, which can be converted to cash within a 1-year period. Okay, always remember that current assets, anything that are current, including current liabilities, are over a 1-year period. Non-current assets can be tangible and intangible assets. Tangible assets are hard assets, for example, property, plant, and equipment, while intangible assets are goodwill, brand value, and intellectual property. Now, this is something that you need to be very careful, yeah. Sometimes companies tend to be overstating their intangible asset, okay, just so that at the end of the day, they have better equity value, okay. So this is something that intangible assets are something that a company could see is brand value, okay, because of the market that it commands, okay, it would have a higher brand value, okay. If let's say that company is a startup, normally the brand value is very low, okay, but established company like maybe BAT or Nestle, yes, their brand value and goodwill and intellectual property, all this could be a much bigger value, all right. But those companies that are on the high tech and their technology is something that is cutting edge, then even though they may be a very young company, but the intellectual property may have a bigger value because their technology could be patented, okay, or they would have certain rights, okay. If let's say it's a technology that is that they are licensed, they have certain rights within the region, okay. No one can possess that technology unless other than this company. Then that intellectual property as an intangible asset value could be quite big as well. Okay, so you need to differentiate in that sense. Current liabilities are a company's debts and obligations which are due within a 1-year period. Now, I would pay more attention to the company's debt actually, because sometimes companies may have a large sum of debt becoming due within a 1-year period. And if let's say if it's becoming due, and if the company current asset is less than the current liabilities, then most likely that company would have to borrow money again, okay, to pay off its current period, but then it will incur a bigger debt in its non-current liabilities, okay. So non-current liabilities are the company's debt and obligations which are due outside the 1-year period. So if we have a high debt scenario in the current liability segment, okay, rest assured, if the current assets are not possible to pay off that debt, then the company's debt in the non-current liabilities would increase so that they would have the money to pay off the current debt. So normally in any company, the biggest culprit, okay, of the fall of a company is over leveraging, okay, and that has a lot to do with how the company manages its debts. Equity is the total net assets of a company after deducting the total liabilities, current and non-current liabilities from the total assets, which is the current and non-current assets added together. All these are found on the balance sheet, and it is also in the balance sheet that important ratios are calculated to determine the company's financial strength. In the next session, we will be talking more on financial ratios. So in this segment, I will just run through some basic ratios here. So cash flow statement. Now, the most important thing is the cash flow from operating activities because it is an important gauge of a company's ability to generate cash from its business. Okay, it measures the operational competence of the management. The other is net change in cash, where a positive figure will add to a company's cash balance, while negative will reduce it. Okay, it is also indicative of the financial competence of the management in managing its financial resources. So sometimes when you look at all these statements, you must ask certain questions. Why does it report in this manner? Why is it not? And therefore, your task then is to dissect it and try to understand it. Okay. Now, very importantly, use those as a measurement, okay, of the level of competence of the management. Because sometimes we know that a company is doing well or doing badly, okay, but we do not know whether the management is competent or not competent. If a company do well, yes, of course, it may show that the management is very competent, okay. Or a company may do well because the management may be competent only in reducing costs, but not in the operational competence, which means generating profit. So that's why you need to look at all the three, okay, and try to ask questions and then dissect it and then reach a summation whether the management is good at what they are doing at its operational level and also in its financial level. Then you would be able to make a decision that is more in tune with your own risk assessment. Okay. So something which you must know also, in periods of severe economic shocks, both cash flow from operating activities and net change in cash may reflect a negative figure. Okay. If there's a very severe shock, okay, as in previous financial crises, okay, the company may have some negative figure. Now, importantly, a negative reading does not necessarily mean that the company is facing financial doom, but it does raise a red flag that the company could face financial distress and that the risk of investing in such a company have become higher. Okay. Now, a company may, for example, may expand, okay, just as the moment that, you know, after their big expansion, there's a financial crisis, and therefore, you know, the business start to drop, and then that company could be in distress because they have already invested so much, and their cash flow now is reflecting negatively. Okay, so if the company has been quite good in managing and overcoming previous crises, then, you know, you just need to take this company and monitor it for a while to see an improvement. Okay, and if let's say there's an improvement, yes, then you know that you can invest in this company. Okay, or you could be a risk high taker based on what you know of the company's financial strength. Okay, although the cash flow may be negative and all those, but its balance sheet is very strong. But because its cash flow is negative and because there's a crisis, the share price may drop tremendously. But if you know the company balance sheet is very strong and they can last through, then maybe you might want to buy it, okay, when it's at the bottom. Okay, so it depends on your level of risk. It doesn't mean that, you know, any company that is negative, okay, then you go and buy. Okay, you need to compare again on the strength of the company's financial health, and that is on the balance sheet. Okay, so cash flow normally has a lot to do with decisions that the management make in terms of debt, in terms of investment, and also how good it is at the operational level. Okay, so but how a company can overcome tremendous shock, that is from the balance sheet. Okay, well, from there you will be able to come up with various ratios. Now, outside of economic shocks, if both the operating cash flow and the net change in cash reflect a negative figure, it means that the management is doing an awful job in steering the company. And in this instance, you should stay away from such a company. So if, you know, all things being equal, okay, others are showing positive, but this particular company in that industrial group, okay, is facing, you know, let's say for consecutive quarters, they have negative cash flow and all those. It means that something is wrong with this company. Okay, and irregardless, because I'm a fundamentalist, yeah, I'm not a technical analyst. So for me, I would stay away from such a company because no matter what people say about this company, about growth and all those things, I would rather give it a miss, okay, than to feel sorry for myself. Okay, and I often base it on the financial statement. Okay, but a technical analyst approach may be different because certain things that certain rumors come up, and then there's a lot of hot money pumping up the company. Then of course, the technical may reflect as a buy. But for me, being a fundamentalist, I often would look at the financial stability of a company to survive crisis, okay, so that I do not wind up with a company that goes into PN4 or go into receivership and such. Yeah, so it actually depends on the level of risk. Then besides the above statements, long-term investor will also look at the dividend and what the management action plans in store to spur future growth of the company. The quarterly report thus include a dividend report and a review of performance report. Now, our case study today would be Padini Holdings Berhad, okay, and this is the income statement. Now you can see that I put in some percentages of change, okay. Now let's look at the revenue, okay. I think quarter on quarter, yes. Sorry, this is not quarter on quarter. Current quarter versus previous quarter, increase, okay. But if we look at the whole year, it increased 21%, okay. So, but one thing, if you look at Padini, okay, their 6 months revenue is 700 over million. And that is why, okay, when you look at the gross profit, yeah, this is called the margin, which means after deducting the cost of sales, this is the margin, okay, at 40%, 42%. So you can see that the quarter ending in December, okay, increased by 2%, but year on year, actually it fell by 1%. So 1% for 700 over million is quite a lot of money, okay, and that's already 7 million. So that's why when you look at retail, I specifically choose a retail company because there's a lot of data that you can interpret, okay. So in that sense, okay, that 1% fall in the profit margin, okay, actually amounts to, based on the sales, okay, it's already 700 over million. So that's why every percentage drop, okay, would actually eat into its bottom line. Now, other income, okay, although there's remarkable growth, okay, for example, at 436%, these are actually quite insignificant in a sense because, when you look at the revenue, okay, of 8 million versus 736 million, it's just slightly about 1%, okay. It's not tremendous, but it does help in helping the company meets its shortfall of that 1% in margin, okay. So if you are looking at it, if you want to measure the core competence of a company, look at how it manages its core business, not so much as other income source. Okay, now all these here are actually expenses, okay, and you can see that some actually did increase quite significantly, okay. For example, selling and distribution costs, okay, administrative expenses, So in this case, if let's say the revenue increase, likelihood, okay, the selling and distribution costs will also increase. So it shouldn't be something that would raise a lot of alarm bells, okay. If let's say, you will hardly have a case whereby revenue increase, but selling and distribution costs actually fell. Okay, so this is more, as long as it's in tandem. Okay, for example, if let's say revenue, let's forget about the comparison quarter this year versus quarter last year, but look at the year on year. Okay, so if let's say revenue increased by 20%, selling and distribution costs increased by 14%. Yes, okay, I can find that is acceptable. But if let's say it increased by 21%, but it increased by 50%, then it would actually hint of something that is not quite right because it's not in tandem, it's already out of sync. Okay, so finance costs are most likely related to debt-related issues. Okay, so like profit before tax, quite healthy at 27%, and profit for the period is 28%. You can see that I don't really look at the tax, okay, simply because the tax rate is fixed. Okay, no matter what the profit is, okay, the same percentage would actually apply. Okay, so I would look at the net profit, okay, and in this sense, it's 28%, which is quite good, okay. Then earnings per ordinary share, okay, is at 28%. Now, sometimes what we have in some companies is that the profit for the period fell, but then earnings per ordinary share increased. Now, why can that happen? Some companies, okay, they make for the shortfall of falling profit by increasing the earnings per share by buying back shares. Okay, so if they buy back shares a lot and that share is out of circulation, okay, that profit divided by existing share in circulation would actually give you a better EPS. So that's why sometimes people like to look at the EPS, but normally I would look at this, the profit for the period, because the company must show that it can increase its profit level, okay? Not so much as knowing how to do some financial engineering and increase its EPS, okay? So EPS. And companies sometimes like to push the EPS higher so that when it comes to the PE ratio, then the PE will be shown as very low. Why? Because if the price is divided by a bigger figure below, then the equivalent of it will be a much lower figure. So that's why some companies, they like to jack down, make the share very attractive when to ensure that its PE ratio remains low, and that's through buying back shares so that the EPS goes up. But they may have falling profit. So that's why it's very important for you to look at the profit level, okay, so that you will know that company net profit actually has a growth and not just the EPS only. So in this
if
case,
I may interject,
yeah,
would you explain a little bit more on share buyback?
share buyback is when companies, they have excess cash, okay, where they want to they often say, you know, well, let's give back something to the shareholder so that we increase the earning per share. Why? Because sometimes dividend may be directly linked to earning per share, okay, as a percentage which they actually apply. So in that sense, the company with that excess cash, they would buy back the share. Personally, share buyback is okay if that company has vast resources, okay, because they want to improve the liquidity of the company share as well. Because if the PE is low, then there'll be more transactions and so on. There's a lot of reasons why management do it. But if the company borrows money to buy back shares, then that is an alarm bell, okay? Because why should you want to borrow money? When you borrow money, okay, the company becomes more leveraged, okay? And you have to be careful when, for example, a company has, let's say in its cash balances, okay, you know, they have let's say 100 million. Then they announce, you know, share buyback totaling 300 million ringgit. Then you should be a bit on the alert side. Why? If the company's net cash, okay, which they have, is 100 million, who is going to make up the difference of the additional 200 million that will be used to buy back the share? Well, sometimes it could be through borrowings, okay, or sometimes that company may say that, okay, based on 100 million, we will buy back over this period of time, so maybe it will be staggered, okay, and not so bad, okay. So you have to be careful, because when company announce buybacks, it depends on how much money they are allocating for the buyback, okay. So buyback often has its own reason to improve the liquidity of company by putting up the EPS higher so that there will be more transaction because the EPS looks attractive. But to me, it's all more to me. I may be different from others here, but for me personally, I often look at the profit for the period and not so much as the EPS, because what is important to me is profit growth, not EPS growth.
Okay. So allow me to put things in perspective. So a share buyback is actually the inverse of issuance of new share, where the company retires some of the shares to reduce the total shares outstanding. Yep.
Yep.
Okay. So could you also explain questions on the 3 months ended and 6 months ended? There are people asking that.
Yeah. 3 months ended means for that particular quarter. Okay. For example, year to date, okay, is 6 months ended. So normally in a financial, you have 4 quarters. Okay. First quarter, second quarter, okay, third quarter, and fourth quarter. Now, when it comes to the second quarter, it's 6 months ended. Okay. Then the third quarter, sometimes they put 9 months ended, and the final one, they wouldn't say from 12 months ended, they would say full year. Okay. Normally they use FY. Okay, full year, which means that full financial year. Okay.
So that means the first column, 3 months ended, means the Q1 of 2016, and 6 months ended is the Q2 of 2016. Am I right?
Sorry?
So you're saying that 3 months ended is the Q1 of 2016, and 6 months ended is the Q2 of 2016.
Q1 plus Q2 of 2016.
Oh, all right. So it's a cumulative two consecutive
yes, it's
quarters.
Cumulative. Yeah.
Right.
Okay.
Okay, you may move on.
So this is just some summary. Revenue growth of 25%. Okay. Not quarter and quarter. Actually, let's put it that way. Q1 2016 versus Q1 2015. Yeah. Okay, and 21% year on year.
Your 2016 is missing.
Okay. 2016 and okay, H1 2016 versus H1 2015. So sometimes they put H1 or H2 because first half or second half. Yeah. Okay. So gross profit margin increased by 2%. Again, need to change this. Okay, but fell. Okay. So important to monitor the gross profit margin periodically. Okay, a consistent drop in gross profit margin could spell trouble for any retail company, because for most retail company, when you look at a very large sum in terms of revenue, that particular 1 or 2% could be quite an influence in the overall profitability of a company. Yeah. Okay. So again, need to change this. Okay, other income, although increased 436%, okay, and 52% first half 2016 versus first half 2015. To me, it's not a main core business. So that's why I term it as other sources of income, which may have some impact. Okay, but here we see that its contribution is quite significant. 8 million in terms of ringgit value, but then in terms of percentage value, it's actually quite a small percentage. Yeah. Okay. Okay. Administrative expenses went up 31%. Again, need to change this.
think in the meantime, when you are editing the slide, let me have you answer some question here. So there's one girl asked us about how does low PE relate to share buyback, which we have just explained. Because when when share buyback happens, the total outstanding shares in the market reduce substantially, and then when the total outstanding share reduced, the earning per share is pushed up. When earning per share is pushed up, the price to earning ratio will fall. So that's just I just reiterate what PC said earlier.
Yeah, and you must also understand that because the whole a lot of people, they hear or they listen or someone told them that always look for a low PE ratio to ensure that that company is still within a range that have further growth trajectory in the share price. So that's why sometimes people always look at companies with low PE as having the better growth potential in terms of the share price. Okay, but I think that what really moves a company price is actually the company's growth in profit, okay, actual profit, and not so much on EPS. But EPS normally is because some people look at it and then they straight away say that, hey, EPS increased so much. So sometimes when people look at the company EPS increase, you will see immediately there's a uptake. But then, you know, as people read through the company announcement, then people would ask, hey, their EPS increased, but then their net profit actually fell. You know, then the share price would then start to trend down. So sometimes EPS is an immediate knee-jerk reaction when people just look at the headline. Okay, so therefore it's very important for you to look at, you know, if EPS growth is also comes with net profit growth, okay, then, you know, it makes sense that this company is really growing, okay, its profit level. But if let's say negative profit, but then high EPS, it doesn't mean that the company is growing its profit, you know, it's just growing its EPS only, okay? So that's a clear distinction between the two. So looking at the balance sheet, okay, there are a lot of items that are put over here in numerical form. It's not by order of importance, okay? But if you look at it, balance sheet, I seldom would want to compare versus the previous year, whether there is any real increase or decrease. Okay, what is important is the current status of the balance sheet, because when it comes to balance sheet, first and foremost, okay, I would look in things like cash at hand and especially the debt level. But looking through this, okay, I think this is very straightforward. Property, plant, and equipment. Company employs this to generate its revenue. And then we have intangible asset, okay, which is about 7 million. Investment property. So Padini actually do invest in property, as there are other sources of income. Okay, club membership. These are for their club members. Okay, available for sale equity instruments. These are, you know, equities that could be bonds, could be investment in bonds, could be investment in shares or whatever that the company holds that they can actually sell it, okay, or intend to sell it within a 1-year period. Okay, deferred tax assets are deferred taxable income, applies in tax paid in advance or overpayment in tax. So sometimes a company may have this, and therefore, you know, it becomes an asset because it has overpaid. Okay, so this one is the total of the current asset. Now, this for me is important. Total current asset. Okay. Total non current assets. Yeah. Then we have the current assets. Okay. Inventories. Okay. Inventories are what the company keep in their stock for sale. Trade receivables. Okay. Those that they sell to distributors and so on and whatnot. Okay. Other receivables are those that they receive from other people. Okay, very straightforward. current tax assets being so low to me is not an important issue. Financial assets at fair value, okay, to profit or loss, okay. These are actually again, financial assets could be certificate of deposit, could be equities, you know, whatever, okay. Cash and bank balances. Now, this for me is important, okay. And in this case, they actually from the previous year balance sheet, they actually increased their cash and bank balances by 62%. So why I say that cash and bank balances are important, because the global economy now is getting very uncertain, and certain parts of the world we see signs of weakening, okay, in US, okay, and then in China. So you know, people say when US and China, when US sneeze, the whole world catch cold. Right now, US and China have potential to sneeze. Okay, so which means it could be if they continue to show weakness, then the global economy might have some tremors here, and that's why having the necessary cash balances to help you overcome the crisis, whatever crisis that may come, okay, is very important. Okay, and if the company can grow its cash balances by 62%, I see it as a good sign. Okay, in terms of non-current assets, well, to me, added together the non-current versus the current, that will give you the total asset value. Okay, and in this case, you see that the company has more current assets than its non-current assets. Okay, so which is a good thing, because when you look at the retailer business, a retailer business is normally that, you know, you operate from a shop or from a store, okay, and then you sell your products. By right, you know, whatever that make up your assets must be inventories, okay, stock that you keep that you can convert into cash, okay. Then of course trade that you receive because you sell it to third parties and so on. Yes, that's the model of your business. Now, if let's say if you are a retailer, but then, you know, your non-current asset is more than your current assets, then, you know, you will wonder where lies the company core business. Okay, so sometimes from this kind of simple comparison will give you an idea whether the company is doing the right thing or not. Okay, and in this case, yes. Okay, what is important that a lot of here, okay, current assets here is a very good sign, because all this can be converted into cash quite easily, you know, including inventories, and then, you know, money that you receive from third parties. Okay, so when we go to the liabilities, okay, so let's look at the equity. Okay, share capital is the capital raised from the issue of shares. Okay, share premium is the amount paid in excess over the shares par value. So share capital is the par value, and share premium is those that is paid in excess, okay, of the par value. So
and
other
when will
reserves,
this happen?
okay,
When they pay in excess of the shares par value?
so there are you know, for example, a company may, you know, they already done the first share issue, then subsequently a company may actually sell another lot of shares, okay, because there's investors who wants to buy. Okay, then that could be a private placement. Okay, and the person who is buying that private placement may be buying a premium, and that's why you have the share premium. Okay, other times, okay, I think the company, if it may not be a private placement, okay, let's say that company is issuing new shares, okay, and it could be a so-called a right, okay, and then people buy the share, okay, which is actually above the par value. which means people with that right comes with the share, with that right to buy that share at a certain price, okay, which is above the par value. Okay, so there's a lot of instances which a company can actually sell a share above its par value. Okay, but in this case, I am more interested in the total equity. Okay, more than how a company have its share premium or share, but I'll be very concerned if, let's say, that company is raising more shares, okay, which then will cause dilution in share price. Okay, so it depends on that. That's why it's important for you to look at those announcements. Okay, and often you see that when a company let's say they decide to raise additional capital, okay, by issuing new shares, then immediately you see that the share price would drop, because just as share buyback would actually remove share from circulation, issue of new shares will increase shares in circulation. Yeah. So, but I think sometimes it also baffles me, okay, why companies would say that I'm giving you a bonus issue, okay? So to please the shareholder, they are giving bonus issue. And sometimes shareholders then would bid up the share price because why? I'm getting a free share. But it never crossed anyone that actually bonus share is actually increasing more share in circulation. You know what I mean? So then, that's why after bonus issue, the share price starts to drop. But when the company announced there's a bonus issue, everyone is bidding up the price. So when bonus share are finally issued, you see the share price falling. So that's why, in the long term, bonus issue or issue new shares through private placement or through right issue and all those, okay, it's actually dilution at the end of the day. Okay, so and normally when you have dilution, okay, again, people would say that EPS would fall, okay, because there are more shares right now. But most importantly, if a company, I wouldn't look at the gauge in terms of EPS and such, but if, let's say, a company keeps on issuing new shares, I would want to see the net profit growth instead, because you are raising capital. Are you employing your capital or not? If a company have raised shares but there's no profit growth, it means to show that the company is actually having some failure in certain segment, in certain sections of the company. Why? Because you are draining, you are draining shareholders' value because you are not employing capital raised efficiently. That is why your profit is dropping. So that's why, sometimes when you look at increasing shares and all those, whether through bonus, right issue, or new issues, okay, you have to be not to be too excited sometimes because it's bonus issue and things like that, okay. But whether the company is actually putting its capital to good use or not, okay. So these are the things that you need to be aware of. Doesn't necessarily mean that a company issue bonus share, okay, then that company is failing. No, but it does show that you have to put the company more in the spotlight, whether through all this capital raising, whether that company is actually employing its capital correctly to generate profit. Okay, so other results like retained profits, okay, 12 and 13 are retained for the business, okay. Retained earnings are not distributed to the shareholders via let's say dividends and such. So you have the total equity, which is total assets minus total liabilities. Looking at the non-current liabilities, okay, long-term borrowings, okay, 7 million, versus last year it drops 17%. Now to me that's important, okay, which means the company its long-term debt, it is reducing its long-term debt, which is a good sign. Okay, provision for restoration costs, being a retail company, definitely, there must always be provision for restoration, okay, renovation and such. Why? because a lot of them have tenancy in shopping malls, okay? And normally it is a fixed tenancy. After a certain period, they must upgrade. So that's why forever, that shopping mall would actually impose on its tenants, okay, to upgrade their facility or improve their facade, you know, things like that, okay, to renovate after the end of a tenancy. So that's why there's always a provision, okay? Deferred tax liabilities, a provision that the company may pay higher tax in the future. So these are pretty common, okay? Current liabilities, provision for other liabilities, well, these are a lot of things that the company may have to pay for other parties, okay? Provision for restoration costs. Now, these are the costs that the company would consume, okay, for renovation and restoration within the 1 year period. Borrowing, short-term borrowing, okay, you see that short-term borrowing increased by 80% versus last year. Now, what does this tell you? Okay, number one, the borrowings from the non-current period have moved up to the current period already, okay? So sometimes it may also be that the company is borrowing short-term, okay? And therefore, it needs to pay off within that 1 year period as well. Not necessarily it means that the company would have debt that from previous financial now has become current. It could also mean that the company is borrowing a fixed amount of sum for the current, okay, just to enjoy the kind of interest that it can have, okay, to actually roll into the business. But it does raise a concern because it has increased by 80%, okay. Trade payables amount due to third party, again, these are related to suppliers, okay, whereas trade receivable normally are from their distributors. This one, they have to pay their suppliers. Other payables, this could be non-trade, these are non-trade related, okay. When it's trade related means suppliers that are supplying to their they're supplying their inventories and so on, because it is related to that trade, okay. Current tax liabilities, provision for tax payable within a year, okay, these are pretty common, okay. Then you look at total liabilities, okay, 380 million, and net asset per share, okay, is 0.79 versus 0.71, which is good in the sense that the company has increased the net asset per share, okay. The company is actually enlarging its equity, okay. So you can see that its equity actually increased by 11% here, okay. And now, as I mentioned earlier, if a company is growing its equity, okay, then that's a reason for the share price to grow. A company cannot just rely on increase in revenue and profit just to have the share price growing, because at the end, you know, there's nothing to fuel the company to capture a bigger market share and to grow the size of a company, because as the company grows bigger, the share price would also reflect a growth in its price. So that's why company must be able to grow its equity as well. So in that sense, the company has grown its equity by 11%. So as I mentioned, okay, dissecting the balance sheet, not necessary to compare all items versus the previous years, okay. Major current assets are property, plant, and equipment. These are the key operating assets. Intangible assets, again, brand value, intellectual property, and goodwill, and investment property. And these are non-operating assets, okay. Major current assets are inventories, stocks, okay, which the company keep to sell to generate cash. Trade and other receivables, these are amount due to the company by third parties. Financial assets, securities, or financial related to investment, and cash and equivalent, okay. While the company makes good use of its financial resources by investing in properties and financial assets, always remember this is not their core business. Do not lose focus by paying too much attention on these items. Now, cash and equivalent increased 62% year on year. Sorry, this is cash balances, not cash and equivalent. Okay, so this is something from a retailer that you can actually gauge here, which they never report. from the balance sheet, but maybe in the summary of performance they would normally report. Okay, now, but you can calculate yourself by referring to the inventories, okay, and the cost of sales from the income statement. You can calculate the stock holding days. Okay, so you have inventories divided by cost of sales times 2. Now, why times 2? Because it's 6 months and it's only half a year. So to average out how many days the company is actually holding its inventories. Okay, so then I use this is the cost of sales. This is the inventories. This is the cost of sales. Okay, times 365, I get 119 days. Now this means that Padini, on an average, is holding its stock for 119 days, which means one particular stock may need 190 days to convert to cash. Okay, so then again, you have to gauge whether versus other retailer to see whether is it around the same number of days. But previously, when I've done some analysis for some Hong Kong retailer, okay, yes, it's always about the 100 to 120 days. Okay, so it means that Padini is falling more or less in line with the industrial standard. Okay, total current assets is an important component in calculating the current ratio, where current assets is divided by the current liabilities. Now, that current ratio will show you whether the company has that kind of financial means to meet its short-term liabilities. Okay, if let's say it's 1 to 1, current ratio is 1, which means yes, they have enough to meet. Okay, but if you if let's say they have less than that, okay, which means that the company may not be able to, their current assets that they have may not be able to meet their current commitment, okay, within the 1 year period. And normally to offset that, company maybe have to borrow, okay, or further down the road, okay, to boost sales so that they have better profit, which they can use to offset. Okay, so when the current ratio is less than 1, it does show that the company could be under pressure to meet its current commitments. Okay, total assets is one of the components used in calculating the total equity. Okay, where the total assets minus total liabilities give you the total equity. Now, the most important component in the current and non-current liabilities are the current and non-current borrowings, because as I mentioned before, how a company manages finances, okay, would determine how good the company is, okay, in surviving a financial crisis. Okay, if let's say the company is over leveraged with that, if there's a financial crisis, then or interest rate environment where interest rate starts to go up, then how is the company going to pay off? Okay, it could also mean that its financial costs are actually escalating if let's say interest rates keep on growing and the company, keep on borrowing just to stay in business. Okay, so that's why, always understand that all borrowings incur interest. A company that fails to control its debt in an environment of high interest can be detrimental to the health of the company financially. Okay, non-current liabilities or long-term liabilities is a component used to calculate the gearing ratio, where the long-term borrowings is divided by the total equity. But normally, I wouldn't look at gearing ratio where normal stocks apply. Okay, but in REITs, yes, I will look at gearing ratio because the limit to the gearing ratio has already been stipulated. Okay, that there must be a limit. Okay, but where other companies are concerned, okay, I wouldn't just look at the long-term borrowings to calculate the gearing ratio. I will look at instead the debt to equity ratio, which is the total liabilities divided by the total equity. Why? Because some companies, because normally some analysts like to look at gearing ratio. Okay, so long-term, they use long-term borrowings divided by total equity. So as long as I ensure my long-term borrowings is low, then my gearing ratio would look nice. Okay, but then I really overload on the current borrowings. Okay, which means I have a lot of short-term loans. Okay, so it rests on the current liabilities and not included in the long-term liabilities. So on paper, it looks nice. The gearing ratio looks good. Okay, but in total, if you use the debt to equity level, then you can see that it really the figure really become very big. So that's why, you know, it does pay attention for you to look at both the current and non-current borrowings. Trade payables will increase versus previous year if revenue rises. Okay, if trade payables are higher and revenue is lower, then the inventories will be higher. Okay, because inventories are convertible to cash. Okay, if let's say inventories are high, okay, if let's say trade payables are higher but revenue is lower, which means you are paying your supplier but you are not generating enough revenue by selling your stocks to pay the suppliers. Okay, so then the company may have trouble converting its stocks into much needed cash. So your inventories keep on piling high. Okay, and you cannot convert, you are not able to convert your inventories into cash. So that's why, you know, you again have to see that whether it's out of sync, okay, or inconsistent versus the revenue. Okay, current liabilities is a component used in calculating the current ratio. Okay, as I mentioned. Okay, total liabilities is a component used to calculate the debt to equity ratio, where total liabilities is divided by the total equity. Normally, I use this ratio, not so much on the gearing ratio for common stocks. But for REITs, again, as I mentioned, I will use the gearing ratio because the REITs gearing ratio is calculated differently. It is total borrowings, not just long-term borrowings. Okay, so you see the contrast. Okay, so net asset per share is a gauge that is used to measure the price to book value, where the net asset per share is the book value. Okay, in a corporate takeover, the potential buyer will look at the book value as one of the components to determine a rightful price to offer to the shareholders. Okay, so looking at the cash flow statements, okay, we have the all these, okay, which are operating cash. To calculate the operating cash, yeah, from operations. So you see that a lot of things are right back. Okay, for example, depreciation, amortization. Okay, so all these cash income not from operational base, and therefore they are deducted. Okay, they are not included because it's not from the operation, it's from other sources of income. Okay, so you have interest expense, which are financial costs, which is, you know, right back to the whatever that are in the expenses are right back to calculate the operating the cash flow from the operations. Yeah, so you have again right back. Okay, right back. Now inventory losses are related to stock loss, because no matter what, there'll be some loss due to theft. Okay, and such. Okay, inventories written down. Okay, these are inventories that's supposed to cost, let's say, 10 ringgit, but then they write back down to 5 ringgit. Okay, because this is called a markdown, which means that inventory has lost its appeal and therefore does not command such a high price anymore. So there will always be a markdown, okay, or written down. Inventories written off normally are damaged stock. Okay, they have to totally write it off. So sometimes, okay, we have inventory losses plus inventory write-off give you the inventory shrinkage, which means how much the inventories have shrunk. And normally people use this shrinkage to measure against the revenue, so that they know that, hey, this company total loss versus the revenue is how much. But in this case, you know, it's a very small percentage, okay, not even 1%. So it means that the company is managing its inventories quite well, okay. And all these inventories, receivables, from here, they come up with the net change. These are the net changes in assets and liabilities, okay. So that after you minus the tax, it will give you the net cash from operating activities, okay. So in this sense, the net cash from operating activities actually fell 45%, okay. Why is that? Because the net changes in asset and liabilities last year was a positive figure, whereas this year are all negative figures, okay. But these are the things that you need to understand, okay. And then you have cash flow from investing activities. You can see that dividend received from other investment, it is dividend received from securities investment, okay, because they also have other sources of income. Then they have proceeds from disposable of assets. Okay, so they dispose an asset which generated 82 million, and they have proceeds from disposal of property, plant, and equipment. Is negligible. Interest received. This has a lot to do with maybe from bank balances. Okay, and purchase of plant and equipment for operational use. These are often called capital expenditure. So you have net cash from investing activities, 68%. Okay, which is good because it gives a positive of 1,000 over percent. Okay, it increased fantastically. Okay, mainly because from the disposal of the property asset. Okay, so cash flow from financing activities. Okay, interest paid is a financial cost. Financing cost, dividend paid is also a cost paid to shareholders. Changes in short-term borrowings, cash received from borrowings. Okay, which is 47 million. Okay, repayments of term loans. These are loan settlement. Okay, and net cash from financing activities is 11 million, which is 457%. So actually, these are cash received from borrowings. Yeah. Okay. So when you look at it, you have the effect of exchange rate. Well, a small figure here. Okay, versus the actual figure. So all in, the cash and cash equivalent stands at 384 million after including the 237 million brought forward from the previous quarter, and that's a 53% increase. So again, they did very well because their cash actually improved by 53%. So the cash flow statement separates the cash flow from business operations, investment, and financial activities. So and financing activities. Yeah. So but the two most important are the cash flow from operating activities and net change in cash. Now, cash flow from operating activities is the same as net cash from operating activities. Okay, so in this case, net cash from operating activities fell 45% versus the previous year, but remained healthy at 63.65 million. Okay. So net cash from financial activities increased by 1,000 over percent. Net cash from investing activities increased by, sorry, let me go through again. Oh, different. This one is supposed to be here. Yeah. So from financing activities increased 457%. From investing activities increased 1,500%. Overall net cash and cash equivalents, including forex gains, rose 33%. Balance and cash equivalent at the end of the 6-month period was a 53% gain versus the previous year. So after having looked at all this, okay, always remember the financial statements are important insights to a company financial health, okay, and growth potential. So make full use of them. Okay, any questions?
All right, so thank you, PC. Okay, now we want to open the floor for questions, but before we open, I already received so many questions coming on board. So if you have any question relating to the webinar earlier on, so please write the questions down and we will do our best to answer every question. Now, some of the questions I have already helped answer through written chat. So the rest, I feel those that are worth discussing, we will bring up for discussions. Now, when you're writing questions, let us do something fun. Let us launch a poll. All right. So do you see a poll on your screen? Yeah, you can please you can take some time to write to answer the poll. Okay, just for some interaction. Now, PC, I'm taking back the presenter control. Is that okay?
Yep, yep.
Okay, in the meantime, you may write down your question. All right, we have 82% of you voted. So let us close the poll now. Okay, let me share the results. So, which financial statement is the most important to you? All right, 13% put cash flow statement, 6% put balance sheet, 5% put income statement, and a staggering 76% of you think that all three financial statements are equally important. All right, so thank you very much. So your hide result now. So now I would show my screen. Okay, hang on, yeah. So I come to the Q&A session. So let me look at some questions. First question, PC. Why audited values is always lower than the original values?
Okay. The most of the quarterly report that comes out when it was first released are non-audited. Okay, because after going through the auditing, there may be certain provisions that are overstated. Okay, or some may be understated, and only with the approval of the auditor will then the financial statement be made. It's like they officiate it. Okay. So which means it has gone through the auditing process and these are true. Okay. Normally, a lot of those normal quarter report that comes out, some could be overstated or understated because it's based on estimation that may be that they think may be material, but later may not be material. Okay.
Okay. Now we got the PC got to do the answer really brief because we have a lot of questions coming. All right. So next question: how do you know that a company is taking loan to purchase share, share buyback to do share buyback?
Well, not that I know or do not know. As I mentioned, if let's say the company cash balances reflect so much, how do a company buy back shares? Because they have to use money to buy back. So if let's say their cash balances is less than the amount that they wish to spend on buyback, then you would know that at some point in time, that amount may have to be borrowed. Okay. So in Malaysia, luckily, you don't see so much of this. Most Malaysian companies are rather conservative. But in US, you will see most of them, like I have 1 billion in cash, but I announced to the whole world, I'm going to use 3 billion to buy back shares. So then immediately people will know, you are going to spend 2 billion in borrowing costs. In debt to buy back the shares. So thankfully, Malaysia are not so aggressive like in the US now.
Okay, so now next question is different industry will have different PE, right?
That is true to a certain extent. Like I say, I don't go overboard in comparing the PE because I would rather look at the real profit growth because the EPS can be reduced by share buyback and therefore does not really reflect the true figure because I've come across companies that have a profit that is lower than the previous year, but the EPS that is higher than the previous year.
Okay. Now, this is a good question. So when a company buy back their own share and never cancel those shares, isn't the EPS remain static? Now, sometimes the ESOS and warrant issuance will dilute the EPS as well. Where can we find more information on the potential dilution of EPS?
Well, when there's dilution, normally outright dilution, you will know that when the company issue things like right issue warrants, because ultimately, you know, new shares will have to be issued. Okay, then you know for sure there's going to be dilution. Okay, and whether the company will cancel it or not, there will also be a report. Sometimes they put as shares that are out of circulation, but they could be in the treasury of the company. You know, some of them will provide that kind of report. If you want to know more in detail of the shares, there's also the an equity report in the quarterly. Sometimes it may not be in the quarterly report. Sometimes it could be in. Some companies maybe would put it in their annual report. Then you would know for sure the movement of equity. But like I say, I'm not one that really look at the EPS really deep, because I am more concerned about profit growth. And for me, that is the measure that will tell me how the company operate.
Okay. Yeah, so next question is, when a company is making a loss, how do we know that they can claim tax credit?
Now the company, all these are actually in the some of them will state it at the end in the equity. Okay, in the balance sheet, in the equity, then they can actually put those kind of credits or whatsoever, if I'm not wrong. Okay, at the end of the day, okay, try not to look at the too deeply into those technical terms, okay, but more on the overall term. For example, however they look at it, okay, if let's say the company is suffering losses, I wouldn't be interested in how much tax credit or what they can carry forward and so on. I wouldn't be interested in the company at all if let's say consistently they are actually suffering losses, you know. So that's why when it comes to looking at a company, you know, to look at the most important thing that you know, like when I share with you in the REITs, okay, there are certain KPIs that, you know, that I always look at as the most important: revenue growth, net profit growth, current ratio. In REITs is the gearing ratio, but here is the debt to equity ratio. Okay, then the price to book ratio, and all this will actually give me an indication of the company's health. If let's say there's that the losses keep on they continue to have losses and keep on claiming tax credit and so on, I wouldn't be interested in this company at all.
Okay, so we got to move on. We have a lot of questions. So next is, what is considered good number in cash and bank balance? Do you have a minimum percentage?
I would not look at too deeply into that kind of percentage, as long as the company is moving ahead away from a lower figure. And if let's say, the current figure is lower than the previous figure, then I want to know why. And if I study the financials, then I may have a summation. Okay, if let's say that company is moving ahead from a lower base, then you no need to be too concerned, because it's an improvement. Yeah, try to look at it in this way.
Okay, so next question is that possible for a company to sell their share below par value?
No. Okay, if the company's par value is already been stated, okay, unless through an announcement in Bursa, let's say they are going to reduce their, the shares now, instead of one ringgit par value, it's going to be now denominated back into 50 cents. Okay, then that has to go through the proper Bursa channel and all those to get the SC's approval. Okay, they cannot just say that now my par value has changed. Okay, they can, but it must be subject to certain regulatory control and approval.
Yeah, can you explain more what is par value?
Par value is, example, if that company share price is based on an issue price of 1 ringgit, that means that company share is the par value is 1 ringgit. Okay, it shall everything be based on that 1 ringgit. For example, a company may say may sell a share then at new shares, okay, issue at 2 ringgit and 50 cents. Then the share premium would be 1 ringgit and 50 cents because the par value all the while has been based on the 1 ringgit.
Okay, but to add on to your answer is that there are some companies who can trade when the share price can drop below par value. The share price can drop below par value, but they cannot sell. When the issuance of share, they cannot sell below the par value, right? So that's to answer the previous question. So for next question is for retained earning, on what circumstances that the company can use this capital? I see sometimes retained earning are not used, but instead raise bond or borrow from banks or rights issue.
Okay, now the retained earnings actually depend on the company. Okay, they could use the retained for multiples of function, but how you want to gauge a company is, okay, at the end of the day, whether the company is growing is equity, so that it gives sense that the share price should also increase with the growth in equity. Okay, if at the end of the day the retained earnings are used to buffer up the company cash, then I will also look at it favorably. Although sometimes people would also look at it unfavorably, because why does a company want to hold so much cash? Which means that the company do not know what to do with its cash efficiently. Okay, but then in the context of the current economic situation where there's a lot of uncertainty and certain parts of the global economy, for example, as I say, US and China are showing slowing growth, it makes sense that I want to have a company that is very cash strong. Okay, not so much as having a lot of money and they do not know what to do with them. I wouldn't say that. I think it's prudent to have a company that has some strong cash balances. Yeah.
All right, awesome. So next question is there a maximum limit of the total number of shares available in the company, or the company can simply issue new shares?
A company cannot simply issue new shares, okay, but whatever it is, they have to go through the regulatory guidelines, okay, and have the approval from the SC. Okay, a company cannot say that right now I don't think I have enough capital to last another 1 year, and then I decide to issue new share. No, I think whatever share that is issued have to go through the regulatory approval. A company in the meantime can borrow money. Okay, so that's why sometimes companies do not want to dilute the share, and therefore they do not want to raise, but then they try to borrow money and see how they can withstand some of the financial stress that they have currently.
Okay, so next question is, without looking at the EPS, how do you determine the appropriate PE to determine whether the share price is worth its intrinsic value or not?
Now, as I say, intrinsic value is very subjective. Okay, that's why I don't look at PE very often. Okay, if that company has shown positive cash flow from operations and it has improvement from the previous year, it has net profit growth, it has revenue growth, to me that satisfies my most major concern. Okay, PE is something that is subjective to a particular industry. Okay, and sometimes companies with high PE doesn't mean that they cannot go higher. Okay, for example, if let's say the company PE is already high, but then suddenly they have profit that keeps on growing, does it mean that and then its share price keep on growing as well? Then its PE price to PE, okay, may have potential to grow higher. We can't tell. Okay, so but when we use that only buy when the PE is low, okay, you are actually not looking at whether the company is making profit or not. You are looking at using the PE and the EPS as a gauge. Okay, so sometimes low PE could mean that the company is not good at all. Okay, why? Because first of all, the revenue growth, let's say the revenue growth is maybe good, but its net profit is not good. okay, then some people would then look at the top line and then they start chasing, because ultimately they see if revenue will grow higher, then the share price will also grow. But then the PE is then the PE the PE would actually be very high, okay, or very low. It depends on how people would value it. If you want to know what is the intrinsic, sometimes people use that for that whole industrial standard. Okay, what has been the PE over the 10-year period, rather than using it as a gauge. For example, I know sometimes people use the like in the US, they use the 10-year average PE. Then if let's say the PE like now is 30, okay, whereas the average ratio is just about 15, then yes, it's almost overvalued by 100%. Yeah, then you know that the entire stock market is overvalued. But to a certain company that the PE ratio is high or low, it may not be able to let you know whether the share price can go any higher or go any. So one of the ways to look at it is that I use the price to book ratio instead. Okay, why? Because if that equity is worth so much, the net asset is worth so much, and if let's say the price to book ratio, okay, is already give you 2 times, okay, then you have to ask yourself, are you willing to pay 3 times, 4 times the net asset value or not? Okay, if you find that if it's not going to, you're not going to pay that price, then likelihood the share price would not be worth that kind of risk. Okay, so I use another method totally. For example, I set my KPI of price to book ratio at 3, which means anything more than 3, I think you can forget about buying it. So that if the price to book ratio then at 2, then I know that the risk for it to reach to 3, okay, will be much higher. Whereas if let's say it's less than 1 or a little bit above 1, then I know that chances are that it can appreciate much greater, because it's just slightly above or below its net asset value. So I often use that rather than using the PE kind of thing, because like I say, as long as the EPS can change, then due to share buyback and so on, your PE becomes unrealistic already.
Okay, yeah, thank you for that. Next question is, may I know the reason why the company wants to issue bonus issue since it will dilute the EPS?
So sometimes a company would want to have more liquidity. For example, if let's say the company is trading at a quite higher share price, okay, they will say that, okay, we want to improve the liquidity, and they give a bonus issue, also something to reward their shareholders. There's a lot of things that a company may say. Sometimes a company want to increase its capital base. So it depends on what the company rationale is. Okay, but only in Malaysia and Singapore, there's a lot of bonus issue stuff like this. But if you look at the global markets in Hong Kong, in US, in UK, there's no bonus issue. There are only 2 things: either share split or reverse split. So actually, so it's a very different market, because apparently the locals here like bonus. So that every time that bonus issue, the share price go higher.
Yeah.
So but then you look at global market, people don't look at bonus at all. Every time you say bonus issue, everyone starts selling like crazy already. They won't beat up the share price. But it's a reverse psychology here. I also don't understand.
Yeah, in Malaysia, I think we have less share buyback. I think we also have less reverse stock split, but we had a lot of stock split, rights issue, bonus issue. That's what I noticed.
Yeah, so it's a very different market segment, you see. But like I say, initial announcement of bonus share, it always goes up. But after bonus share, it never goes back to the actual price. Forever it stays down. So I think don't be too excited about bonus share sometimes.
Okay, let's come back to the next question. How can we know whether the company is a net cash flow? I think what he's trying to say is that, how do we know that this company has positive net operating cash flow? Yeah.
Through the income statement, they will already say
through the cash flow statement.
Next page, yeah. As long as it's positive and as long as it's an improvement, then the idea that this company is generating better cash flow from operating activities make it very interesting to consider this company.
Okay. So next question is how to determine that a company is a cash-rich company?
I think first you look at their cash balances, okay? Like just now in the balance sheet, okay, we look at the current asset, okay, and it's cash in bank, okay, it's 300 over million versus its total asset of let's say 900 million. Well, that's more than 30 over percent in cash, you know. So I would consider that, you know, it is as a percentage of its total assets. Yes, it's rich in the world. Sometimes people think that that company cash rich must be in the billion billion ringgit or so, you know. But then it's that could be another few billion. So that's why again sometimes do not look at cash as something to let you decide whether you should buy this company or not. Always go back to performance. Okay, performance is such thing like net profit growth, revenue growth. Okay, how the company manages its debt, which means a low debt. Okay, and good ratios in current ratio and in debt to equity ratio. Then you know that this company has the financial strength, okay, to overcome crisis. Otherwise, if it has a lot of cash, but then it cannot generate business, then what for? Okay, so don't use that as a criteria.
Okay, great. Now, actually, it's already 8 minutes past 10. I still see a lot of questions coming in. So if you are still typing in questions, we unfortunately can't cater to so many of you. So we will just stop right here. Okay, the questions. But in the meantime, we will do our best to answer all the available questions right now. So if don't type any more questions because we are unable to cater to all already. So next question is the industry standard 100 to 200 the same for all sectors? I think his question is referring to the stock holding days.
Industry standard, okay, based on some research I've done previously on Bossini and Giordano international companies, is about, you know, around 90 to 120 days. So as long as that company, you know, like in Padini, okay, it is within that range, means they are following an international standard. Okay, if let's say it's 150, 180, means that company, you know, is not performing to that kind of international standard. So that's why if you are holding retailing stocks, okay, you need to measure that whether they are meeting that kind of standard or not.
Okay. Next question is how can we detect fraud in the financial report?
I think we can't, by looking at it, we can't detect. Okay, that is why we have to be very careful. Okay, that a company must have that kind of we can only based on so-called circumstantial evidence on the report. But if let's say they are overstating or underestimating to boost it up, normally it will come much after. You know, you remember last time that this air transport company, I can't remember, was it Transmel or what? You know, they actually overstated by so many hundreds of million. You know, you mentioned the company, you know, it's gone case already. So that's why we normally do not know until the auditor found a mistake, and then they, you know, the company eventually have to announce, because otherwise they are liable and they could be severe repercussion from the SC. So we can only rely that they would follow by having a good auditor that will audit them, you know.
Okay. So next question is there any different approach to study quarterly report and annual report?
I think the annual report normally comes out towards the year end. If let's say you are beginning of the year, okay, let's say right now in the perhaps in the month of March, a lot of companies would have already come up with their annual report. So then you can look at the annual report for more detail. But after that, okay, once you are into the second quarter, you have to look at the first quarter of this year and not rely so much on the annual report.
All right. So normally when you read a financial report, which report will you look at first?
I will look at the income statement first, okay? Because if the company is suffering losses, then no need to say anything already.
Yeah, yeah. Actually, I also study income statement first. So for company issue IPO, we can analyze whether it's a company to invest. How can we? I think what she's trying to ask is how can we analyze whether it's a good company to invest for IPO stocks.
I think for IPO stock, that's the preliminary. In the prospectus, they actually have their financial statement. So one of the key thing is, if you want to make sure that this company upon listing at least can survive, yeah, okay, then you use that balance sheet as something to help you determine whether you should invest or not. Its profit and income statement may look good, okay, but if you look at its balance sheet, if everything is very borderline, okay, how I determine borderline by putting certain KPI. Then if let's say it's very close to the borderline, then you might want to give it a miss. Okay, and not all companies, right now I think investors are more savvy. People are getting smarter, and people are different mentality from those in the 1990s. It's like 1990s, people say IPO, you spend whatever money, you go for it, sure can rise one. Nowadays, not all IPO will actually rise in price. After IPO, it may be hot for 1 or 2 days, then it starts to fall. So that's why it's different kind of mentality already. So use the balance sheet as something to help you determine. Okay, if the debts are high, then you might not want to consider. But if revenue and profit growth is very good, and you can, let's say the debt is borderline, you may want to bid for it. Yeah, it actually depends on your risk assessment.
Okay, next question is how important is stock holding days calculation?
I think stock holding days calculation is not very important if, let's say, that company, like I say, if revenue, if trade payables are high, okay, which means trade money that the company pay to the suppliers are high, revenue is low, then you might want to calculate the stock holding days, because you want to determine whether the company would have problem converting its inventory to cash or not. But if let's say the trade payable increase but revenue is also increasing, then you may be more forgiving and not look too deeply into the stock holding days.
Okay, so next question is inside the cash flow statement, what do you mean by write back?
Write back, which means like when you do your income statement, okay, there are certain expenses. So these expenses are deducted from the revenue to derive the net profit. Okay, but cash flow is everything that the company earns as a cash from the operations. So that's why whatever cost you minus out in the income statement, you have to put it back to the cash flow. Okay, because you want to know what is the total cash flow generated. So that's what I call write back, because in the income statement it was written as something that you deduct off. Okay, so in the cash flow it's write back.
Okay, but having said that, I have one question at PC. Usually, I also do look at free cash flow, but I see that you didn't cover free cash flow. Is free cash flow important to you?
I think free cash flow is may not to me it's really not so important in a sense, as long as the company let's say from their operating profit from their operating cash flow, is a continuing increase. Now, sometimes it's let's say free cash flow, because after you minus everything, okay, that's still it is still in excess of others. Then they have that what they call the free cash flow. But to me, most important, I will always value a company based on operation more, okay, than how they actually look at the after deducting everything, what is the net? Because if let's say the company has certain financing, it could be negative, okay, but then like in this case, financing activities is positive, but let's say it's negative. Then if let's say the the operating cash flow is very high, and the financing activities is, is a small sum, then I no need to worry about free cash flow actually. So I would normally look at the operations side of it more.
Okay. So next question is, how do you decide a buy after reviewing a good financial statement? Do you use margin or safety approach or other approach?
Yeah, that's why I say I use a KPI method, and in invest in REITs, I actually come up with certain KPIs that I set. This is give me certain margin of safety. For example, people will say that like based on my experience of so many years of investing, a lot of companies actually have current ratio that are hovering around 1 to 1.2. But then, for certain high so-called high capitalization industry, I would accept a cash flow of must be more, sorry, not cash flow, current ratio of more than 1. But if let's say for retailing industry where there's not high capital intensive, I would raise my bar to 1.5. So the current ratio must exceed 1.5.
Yeah.
So that I consider a company having a safety measure, Yeah. So that's how you build your own margin of safety, by instituting a KPI that meets your own risk assessment.
Yeah, so for you to know our speaker KPI, please attend our next webinar as he would disclose to you what are his KPIs in selecting stock. Am I right?
Yeah, yeah.
All right. So
I
the
would
link
get
is
some of
already
them.
in the chat. Okay. So yeah, next question is, do we really have to search for all information regarding the company before we decide which stock to buy, including the background, the history?
I think try not to look so much into the history, as I say, because right now everything is digitized in this world, and technology are always constantly on the change, and therefore management reaction to change is the most important. Okay, that's why look at the current, not so much as previously. Okay, but you must understand the trend. Okay, for example, a lot I think, how do one actually select the stock? For me, I look at trends first. Okay, for example, if let's say commodity market is pretty quite badly hit. Okay, a lot of those commodity price are actually falling. Okay, then I would say that, well, if let's say what happened if let's say U.S. economy suffer a crisis, then they would print more money. Okay, and what happened in the last financial crisis? Well, the U.S. printed a lot of money. Okay, and a lot of money flow into resource-based economies like Malaysia. Okay, in Southeast Asia. Then I would say that, okay, I will be looking out for this trend. And then when if something like this happen, then I will say, okay, then it's time to go into plantation stock. So, just like another trend, for example, oil price, actually, the last one we had, the last webinar is pretty interesting because I'm quite well versed in the oil and gas industry. I'll be sharing also a lot of drilling methods. But let's say in the last price hike, okay, everyone was saying OPEC is cutting production. Then, suddenly everyone's like, oh yeah, they clap their hands, let's move into oil stocks in Malaysia. Okay. But then the US keep on ramping up their production, and the storage at the Cushing storage facility, keeps on reaching to the limit. Then you know that OPEC oil price will be insignificant because the US, which is also another world large world producer, okay, to the tune of about 9 to 10 billion barrels of oil per day, okay, they will actually offset whatever OPEC price, OPEC reduce in production would help the price. So that's why you see oil price trending down. So that's why if you understand this, then you wouldn't immediately rush into buying those oil stocks as well. Because if oil price come down, a lot of Malaysian oil price stocks will actually fall. Okay, so that's why it's important for you to understand trend, understand what is happening, then only select the stock. Okay, rather than simply pick a stock and then analyze and then see what it is. Okay, so these are the things that if you look at certain trends, for example, if US dollar is very strong, what are the companies that will benefit? Okay, maybe those that are actually doing manufacturing for the international market. Then you look at all these stocks. Okay, only then you do a research. Not pick any stock, from whichever you feel like it, and then you do an analysis. That's why you will be wasting time as well. So if you understand what is the trend, okay, global market trend, and how the impact of US economy or China economy could influence Malaysia, then you would be able to go into that particular segment of the industry, do an analysis, and then, decide whether you want to or not.
Okay, so PC, you gotta give your answer really short. All right, no problem.
Maybe
So
yes or no.
yeah, next question is for educational company. What if the cash flow from financial and investing activities is negatively higher than the operation cash flow?
Okay, the financing activities, then you have to look at it whether is it related to the to what they are doing. For example, building a new campus or things like that. Okay, so if let's say it's positive, then then the cash flow, even though it's negative, I may think that, hey, this company they have bigger plans. Why? Because they borrow a lot of money, okay, to finance a campus, okay. But as long as their revenue and net profit growth, okay, is there and their balance sheet stays strong, always go back to the balance sheet, because balance sheet determines the health of a company, okay. Then other positives will come from the cash flow, okay.
Okay. So next question, how do you foresee a future growth from a financial statement, since financial statement only reflects the past?
Okay, now if let's say you understand a certain market trend, okay, you know that this based on the whatever that's happening externally and internally, this could be a trend. Now if that company profit growth or revenue growth reflect a good positive figure, that means they are meeting your trend expectation, which means there could be further room for it to grow, okay. Now the other thing is to read at the management review of performance, okay. The company would tell what are the plans in store, what are they doing, okay. And then sometimes if you are interested in a particular stock, go to the announcement page. The company may announce certain plans or certain joint ventures or whatnot. Then you will know that, hey, there are only from this you will know that the future is even brighter for that company, okay. Not just by the financial statement, okay. You have to go further to read the management review of performance and whatever announcement that comes out that is positive for the company. Then you'll see how it will reflect on the future revenue and profit growth.
Okay, so yeah, next question is based on the information of the Padini given, the short-term borrowing increased 80% only within the 1 quarter. Is that behind got any bad signal?
Okay, that 80% is not 1 quarter because it's measured against the previous year's balance sheet of in the 1 quarter. This year was in that particular quarter versus the end of the period of the same quarter last year. Okay, so 80% means that they could be having a short-term borrowing. Okay, so at the end of the day, you look at its current ratio. Now, if let's say its current ratio is higher than its current liabilities overwhelmingly, okay, then it's really not that bad, even though you see a 80% increase. Okay, so for a short while now, current asset is 763. Current liabilities is 362. So it's more than the ratio of 1. Definitely. Then for me, Padini being a retailer, okay, then I will look not really high capital intensive. Then I would see that if 763 divided by 3.62 is a current ratio of almost 2. Then I would say that, yeah, this company is safe even though its short-term borrowings increased by 80% because its current ratio is 2 times its current liabilities.
Okay. So next question is, after we bought the share, when is it we should sell? Is it after the share price drop? If no, when do we know we should sell?
I think all of this depends on your level of risk appetite. Sometimes Now, sometimes people buy, okay, and then they drop 10%, they start to be panicky, then they sell. If let's say, if a company is good, okay, and that's why I always stress, because again, I'm a fundamentalist. If I can buy a good company, okay, I'm more prepared than ever to hold it on a more longer term period, okay. Some stocks I buy, I've been holding it, I think for 5 years even, okay, just enjoy the dividend and so forth. And then, if I'm not under pressure to sell, then I won't sell, okay. So it's just like what Warren Buffett say, Coca-Cola is a company that he never wish he wants to sell. During the last financial market, Coca-Cola shares dropped, I think, by 50 over percent or 30 or 50 over percent. He still don't sell, because if you really have a good company that's financially sound, then how much prepared are you to watch it grow? Okay, in the end, it's back to your own risk assessment. If you cannot take it, you want to sell, it's entirely up to you. Okay, and if you see certain appreciation in price 20%, you want to sell, it's also up to you. Okay, and if you want to hold on longer term to realize, let's say, a 50 or 60% gain, then it's also entirely up to you. At the end of the day, is how are you able to accept that kind of risk or not? Okay.
Okay, so another way of looking at share buyback, people are saying that because internal know their coming quarter are performing well, that's why that's why they will issue share buyback. Am I right? So that's the question.
I try not to look at what internal things are, because do not let rumors cloud your judgment. Okay. Often I look at the hard facts. I don't listen to rumors. Okay. Yes, I do miss some boats when I don't listen to rumor, but at least I know whatever investment I make is due to my own due diligence and my own commitment to buy it. Okay. And not blame other people if, let's say, it fails to meet my expectation. At least I'm prepared to live with that fact. Okay. So very importantly is whether you are the type who wants to listen to rumor, or you base it on hard facts, and that make you determine that you should buy.
Okay, 2 more minutes before we hit 10:30. So there are a few last few questions. Some I have to skip already. So at what amount dividend will be taxable? Is all dividends taxable?
Uh, all dividends are subject to a 10% withholding tax. Yeah.
Oh, okay, but I thought in Malaysia is single tier tax structure whereby when the company got taxed once
Um,
on the net profit,
I'm not
the dividend
so
is not.
sure about that. I'm not so sure about that, because those that I own, okay, sometimes are subject to the 10% withholding tax. So at the end of the day, okay, the dividend, if you less that 10%, if you measure against the share, as long as it give you a yield, okay, that is above than the FD yield, then it is something that perhaps you can live with. Okay.
Okay, so I want to know, is fundamental analysis considered as long-term analysis? If I'm a short-term investor, where should I rely on?
I think if you are a short-term investor, then you should look more on the technical side, but must be supported by, at least supported by some fundamental analysis, so that at the end of the day, okay, your how to put it, so that at the end of the day, the technical will be supported by a sound company, so that you can maybe hold on to a longer period to wait for the technical indicator for you to exit to really help you with your trading. Okay, but if you just follow the trend on the technical, you need to be very quick. Otherwise, if that company is not sound, any bad news that come up will actually impact the company quite drastically.
Mm-hmm. Okay, next question is, may I know why the company want to do share split? Is it good for the share price?
These are subject to the company management. Okay, sometimes they may want to do a share split to actually improve the liquidity. For example, if the share is trading at 30 ringgit, they might want to do a split of 1 to 5 to lower the share price. Okay, so that it will actually encourage people to buy. Actually, it depends on the management objective. Okay.
Okay, so with the new Companies Act, where one share have no par value per share, how will this impact the listed company in returning money to shareholder? This is a very deep question.
This one is a bit tough one.
Yeah.
I think at the end of the day, okay, you must know what drives your investment. Okay, is your investment being driven by future growth? Okay, with a future increase in price. Okay, and in the meanwhile supported by dividend. And try not to look so much into the technical of how a company is being run, especially when it comes to those things like bonus issue, rights issue, and all those. Until the announcement come in, then you evaluate how your next strategy is, because you cannot buy with the expectation that the company would be issuing bonus issue or whatever sometime in the future. What you do know currently is that based on the dividend yield and its profit growth and net profit growth, yeah, and its balance sheet. Okay, try not to look too deep what the future will impact. If let's say, the company have not even made any announcement.
Okay, so next question is, what is the most important aspect to review a company? Mainly based on net profit growth per year? This one I haven't answered. You want to know more about what are important KPI? Join our next webinar. All right. So next question is, I would consider this the last one already. How do financial statements treat events occurring after the end of the reporting period?
Sorry.
How do financial statements treat events occurring after the end of the reporting period?
Okay. If let's say the whatever that is after the reporting, period, whatever that comes in, okay, the reporting period is already gone, is for whatever that is in the past. That's why if you are interested in your company, don't just read the quarterly report, be attentive to whatever announcement that will come out from the company, because that is the most present guide you can have. Okay, so what the financial statement does is to give you an indicator to help you make your own risk assessment. How the future, of the company is, you have to look at the announcement, and in the quarter report, what the management give any insight into the future growth of the company or not. Okay, so that's why financial statements are only good, okay, for what the company status is and the direction is based on their profit and net profit growth. But certain things that can happen after that reporting period, which could be positive or negative, and that is why you need to stay on top of the game.
All right. So, well, we have come to the end of the Q&A session. So we had received about, I think, 50 over questions. We managed to answer 30 to 40 questions. There are still some questions that we didn't manage to answer, but because of time constraint. But for those of you staying up until now, thank you so much for having the patience and the desire to learn in this webinar, because you guys are the best. You stay until the end to listen to all the question and answer. Now, so how can we propel your journey forward is that in the next webinar, we're going to talk about mastering financial ratio. For those of you who ask about what are some benchmarks, what are some ratio you look at, what are some criteria when assess the financial statements, join our next webinar, because we are going to tell you, PCs is going to share with you his approach on how he can, what are some benchmarks he look at when it comes to interpreting a financial statement. What are some ratio you look at above what ratio is good to invest in a company, above, below what ratio is the red flag to the company. So these are the things that we'll explore in the next webinar. It happen on 2nd of May 2017, 8:30 to 10 o'clock, and you can register in the link that I've just given you in the chat and on the screen. With that, thank you very much everyone for staying up late. Remember, at the end of this webinar, we will also do a survey. Please help us to complete the evaluation survey. Thank you very much and have a pleasant evening.
Yep, and have a pleasant evening to all of you too. Thank you for tuning in. Goodbye.
All right. Yeah, bye.